Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2020 Forex course. Welcome back to Module 4, Forex Expert. Lesson 2, Commodity Correlations. Let's speak about the Forex asset class specific zone qualifiers, cross-asset market correlations, so-called commodity correlations. The greatest long-term correlations that exist in this commodity space when it comes to the Forex markets are gold and crude oil. So this is the agenda for today. At first, we will talk about correlations and what they are and how we look at them. We will talk about the economic indicators, crude oil and gold in more detail and how they affect some of our Forex markets like the Canadian dollar, the Aussie or the yen. Of course, when we talk about gold, we also have to cover silver. And at the end, I will show you how to set up a correlations workspace using TradeStation and how you can use the correlations table from MRCI as a tool to include into your weekly and monthly trading routine. Correlations is a term that comes from the mathematical world of statistics, and it ranges from 1 to -1, or 100% to -100%. 0, the golden middle, means that two markets are random, meaning that two markets are completely independent and random from each other. 1 is the most powerful positive correlation. Positive correlation means that two markets move in the same direction at the same rate of speed. Negative correlation can be as low as -1, and that means that two markets are moving the opposite direction, again at the same rate of speed. We will look at correlations that are either greater than 75% or lower than -75%. However, this is only a ballpark number that we generally use. Two markets can also be correlated and move in the same direction without the same rate of speed, which can happen during certain market environments. So a 0.5 or 50% could still be a strong positive correlation if two markets or two products generally move into the same direction, but not at the same rate of speed. A good example here is going to be the Aussie dollar and gold, which we will look at a later stage. So when we apply the statistical analysis of correlations to the chart, it is going to be important for us to understand that we do want to use this for context analysis and not for mathematical calculation. Oil is the engine of most economies. Almost every economy is influenced by oil in some way. The loonie, so the Canadian dollar, is highly correlated to crude oil. This is because Canada is a very active and powerful resource country, in specific when it comes to crude oil activities. Globally, Canada is the fourth largest producer and fourth largest exporter of crude oil. Most of this crude oil comes from these tar sands companies, which also have been taking a lot of heat due to its supposedly poor environmental and social outcomes, locally and globally. But more importantly, tar sands projects are also extremely costly and capital intensive. And with the cost of production being extremely high, Canada generally benefits from higher or increasing oil prices. Therefore, we can say that a higher demand for crude oil also means a higher demand for the Canadian dollar, the loonie. And with decreasing demand on oil, there's also decreasing demand on the Canadian dollar. This is what we would call a positive long-term relationship. If the price of crude oil goes up or down, so does the value of the Canadian dollar. So crude oil and the loonie are positively correlated. In the Forex world, we are trading the inverse of the Canadian dollar, the USD CAD, with the Canadian dollar being the quote currency. Therefore, crude oil and USD CAD show an inverse correlation, a negative correlation. So here you can see this translated into the chart looking at the USD CAD crude oil correlation over the past 5 years. This is a very good example of a strong negative correlation because these two products generally move in the opposite direction. But they do this not always at the same rate of speed. So most of the time you will see an actual statistical correlation of -0.5 only. even though these two products may be moving similarly. This just means that they are not moving at the same exact rate of speed. So one may be rallying faster in terms of percentage moves than the other is dropping, and vice versa. So if you look at the price action from this year, beginning of 2020 to today, we can see that these two products generally move in the opposite direction, even though the statistical correlation that you see at the bottom doesn't always show a strong negative correlation of minus 0.75 and below. So more important than the statistical correlation is overlaying these two charts and understanding that they have a longer term relationship. They do move similarly, even though not always at the same rate of speed. Another important finding here is that correlations sometimes completely cease to exist, meaning that any given correlation does not necessarily exist all the time. It can be stronger, weaker, or completely random and kick only back in after a while. Therefore, we must live by the rule that correlations exist until they don't. JP Morgan once said in front of Congress back in 1912, "Gold is money, everything else is credit." This is still true and very much accurate more than 100 years later. Today, currencies are no longer pegged against gold. Rather, currencies live from the trust in the system, so-called fiat money. And fiat money only exists in form of obligations. Today, gold is considered the ultimate safe haven and is generally more demanded during times of economic and socio-economic uncertainty. There are many fundamental drivers for the demand of gold, but the two major fundamental drivers for the demand of gold are listed here. Number one, the lower the real interest rates, the higher the price of gold. Most people will look at nominal interest rates and they fail to distinguish between nominal and real interest rates. The nominal interest rate is the rate the Fed controls, which is currently set at 0.25%. The real interest rate is a little more complex. Real rates are basically inflation or deflation adjusted. So this rate really reflects the real yield to the lender or to an investor. The 10-year Treasury note is a good proxy to use here because it reflects longer-term investments such as construction. So if you're looking at the 10-year Treasury notes today, the yield is at 70 basis points, so 0.70%. Adjust inflation, which is around 1 to 1.5% today, depending on the inflation index you're using, and voila, the real rate will be negative. So the real rate is already negative, and even without the Fed going into negative interest rates, the real rate can go a lot lower if inflation kicks in and consumer prices become more expensive. And secondly, gold tracks the US federal debt. So we have recently seen a mega purge of credit, with the Fed going into QE infinity since March 2020. So gold tracked with that, and the Fed is constantly fighting against deflation. So it is going to be interesting to look at gold prices when the Fed intervened back in March 2020 and 2009 when they first launched QE. Here you can see inflation adjusted 10-year Treasury notes since 2007. Real interest rates are now once again at negative percentages, even lower than during the low of 2013. What you can see is that this chart is basically the inverse of gold. Therefore, gold and inflation adjusted real interest rates are strongly negatively correlated. In November 2008, we could see a quick spike in real interest rates. The top here marked also the bottom of gold after the housing crash, and therefore the beginning of a major gold bull market, where gold had managed to rally from $680 per ounce all the way up to $1,920 per ounce. Another interesting point of history are the November 2018 highs, which again marked the beginning of the current major bull market in gold. And while real interest rates make a lower low and are clearly in a downtrend, gold makes a higher high and is clearly in an uptrend. Here an overlay of gold and real interest rates. Here you can see the strong negative correlation of the two. Now, charts are charts, And when we don't have candlesticks, we use trend lines to better understand the direction of real interest rates. Here is the amazing dynamics. Back in 2019, real interest rates broke out of this formation prior to gold, and with that predicted the major gold bull market we're seeing today. This is an important chart for the long-term gold buy and hold investor, and as long as real interest rates are dropping, we should be very bullish on gold. Since 2000, you can very accurately track the total US federal debt, which is really the total public debt, and gold really tracks this over time. In Q2 2008, you can see debt skyrocketing, and Q1 2020, once again, debt exploding to the upside. What is interesting to observe is that we have been solving every problem with more debt. And while in 2000 it only required a marginal debt increase, every time there's another problem like 09, it takes tenfold the money. And once again in 2020, we're seeing a debt increase which has been unprecedented. This exponential increase of debt cannot be healthy for an economy. You could further spin the wheel and talk about debt to GDP ratios and all of that, which would just show that the US is on its way to catch up with Greece or Lebanon, which we know today are not healthy economies. Now, this is also an interesting chart overlaying gold and the federal debt from 2000 to today. Look at this, quite amazing, isn't it? A very strong positive correlation between gold and US federal debt. Gold basically has been tracking that for more than 20 years, and every time there was a major turning point or steep incline of that, you could see gold shining going into their biggest bull phases, just like 08 and today, also a very relevant chart to the long-term gold bull. To summarize, now you understand the fundamental reasons of why gold is considered the ultimate safe haven. Gold tracks with inflation and deflation. As inflation increases, gold tends to go with it. So gold is seen as an inflation insurance. But also on the other side, as deflation increases, gold also drops. This is important because gold will also drop during times of deflationary phases and recessions like the 2007 to 2009 housing crisis or the February-March 2020 Corona crash. Gold tracks the US public debt. The more debt, the more difficult it is for an economy to have structural growth, which you could also see from the previous lesson. With debt expanding exponentially, the average annualized GDP growth also shrinks. While the major 1990s bull market had an average annual GDP growth of 3.2%, the recovery after the 2000 dot-com bubble only had a growth rate of just over 2.4%. And after the housing bubble, the average annual growth rate was only at 1.2%. Therefore, the proactive long-term investor understands that more debt means a longer-term shrinking economic growth. And with real interest rates going into the negative territory for the first time since after the housing shock, gold again shines. All these three fundamental drivers for gold are currently green. We understand that the monetary system is highly leveraged, indebted, and only kept alive through massive intervention from central banks. Therefore, for wealth protection reasons, we recommend 20 to 40% of your wealth to be stored in unleveraged physical gold or silver, and this will be your personal wealth insurance. Now, I just mentioned silver, and we cannot talk about gold and not talk about silver. There's a long-term positive correlation between gold and silver of approximately 0.87. This means that when gold rises, in most cases, silver also rises linearly to gold. And if gold drops, silver drops. So silver behaves similarly to gold. What is quite interesting to observe is that during recessions, gold outperforms silver, while during the aftermath, silver will catch up and outperform gold. This was very interesting to observe during the 2009 housing crisis. The price ratio can be seen from the gold to silver ratio, which we can look at through a free account on TradingView. So let us learn to read this chart. On the horizontal, you find time. The vertical shows the ratio. Therefore, this chart represents the gold to silver ratio from 2000 to 2020. Currently, the price of the silver to gold ratio is at approximately 70. We would read this just like any other currency pair. This means that 1 ounce of the base currency, gold, is 70 times more expensive than an ounce of the quote currency, silver, meaning we can buy 1 ounce of gold for 70 ounces of silver. Now historically, this means that gold is pretty expensive in terms of silver. But what does this mean? Let us take a look at the last 20 years of silver to gold ratios, find historic trend changes, which will give us an idea of what to expect from the future. What becomes extremely visible are the bigger picture trend changes in the ratios of gold and silver. In general, whenever this ratio is at or above 80, silver is fundamentally overvalued, meaning we would be looking to buy silver. And whenever the ratio is at or below 40, silver is fundamentally overvalued, meaning we would be looking to sell or short silver. Not today, not tomorrow, but it gives us a macro context bias in terms of fundamentals. From 2003 to 2006, the ratio went from approximately 80 and dropped all the way back to 45. This resulted in a massive spike of silver prices. During this period, silver could gain 182% and even outperformed gold. From 2009 to 2012, the ratio went from approximately 80 and dropped all the way to 35, which again resulted in a 400% rally in silver prices, meaning in just 3 years, the value of silver quadrupled. During this time, once again, silver outperformed gold. This is just what this chart is telling us. And then in March 2020, this year, something incredible happened, something unprecedented. In March 2020, we were looking at an all-time high readings of 126 gold to silver ratio. This has never been seen before in 100 years of measuring and recording silver and gold prices. In other words, silver was extremely cheap in comparison to gold. Actually, silver has never been cheaper before. And usually, these extreme valuations are not sustainable. What you see once again, just like you saw in the previous cycles, first during the crash and the crisis, silver underperforms gold, and during the aftermath, silver will catch up and outperform gold. But we also see that this is just the beginning of a potentially huge move in silver prices. The cool thing here is that we can also apply our supply and demand analysis to understand potential entries on silver. Currently, the ratio is in a high quality demand area. Therefore, we can expect this ratio to rally a little bit, giving us a bounce potentially all the way back into weekly high quality supply. Therefore, right now, we would not want to buy silver. But if this ratio is back in our weekly supply area, we can be looking to also buy silver, if silver at that point is also in demand. And afterwards, we would expect the ratio to go back lower into the other side of the valuation side, 40 or lower, or overvalued. This is because valuations can be portrayed like a swing. The harder it swings into one direction, the more force it is going to have when swinging back. Therefore, it may not necessarily only stop at the median ratio, it could go back all the way to the overvalued readings of 40 or below. If this happens, we can expect a massive silver rally during this period. It is likely to also overperform against gold as it did in 2003 and 2009. In other words, this is potentially a huge opportunity to buy silver. We are seeing silver catching up to gold in front of our eyes. Let us do the analysis on TradeStation. What we can see is that gold has already entered a bull phase with a clear weekly uptrend, consecutive higher lows and higher highs. However, silver, just like we talked about, is lagging. It has only now broken out of the sideways trend and created a new high. It is yet to create a new higher low though, and it is our job to anticipate the higher low to be formed within higher time frame demand. For everyone who's been following our live trading sessions recently has seen these levels before. Weekly level on top of level, where we will expect price to form a higher low if and when price comes back, from which silver will go into a massive bull market following and outperforming gold. We should also expect silver to go into an all-time high if gold will continue to go even higher. So as you can see, we're just at the beginning of a new silver bull market. In summary, silver and gold are strongly positively correlated. They generally move into the same direction. However, silver has this lagging effect, as it usually suffers more from economic downturns. However, as silver is catching up during historic gold and silver bull markets, silver usually outperforms gold. This is very relevant today, and it is our job to get a handle on silver to be trading potentially the biggest silver bull market that has ever been recorded in history. We will do this through our supply and demand strategy, looking at the demand areas on silver and mapping those to the supply areas we see on the gold to silver ratio chart. Now that you understand gold a little better, let's move on to a few more relevant cross-asset market correlations between gold and some of our currencies, in specific the Japanese yen and the Aussie dollar. The Japanese yen is also known as a safe haven. Therefore, gold and yen show a positive correlation. Since we are trading the inverse yen chart, USD JPY and gold will show a negative correlation. And Australia is also affected by gold prices, not because their currency is also known as safe haven, but because Australia, just like Canada, is a huge resource country. Not in oil like Canada, but Australia is the second largest producer of gold. Australia has seen a record-breaking year of gold production in 2019, and some resources estimate that Australia has the world's largest economic demonstrated resources of gold. So in general, the greater the demand for gold, the stronger the demand for the Aussie dollar. You can see the long-term relationship between the Aussie and gold right here. They generally move into the same direction. Although they do not do this at the exact rate of speed, also from 2019 and 2020, gold and Aussie were detached from one another. Again, correlations exist until they don't. But with the recent rally and bull market in gold, also Aussie has been rallying ever since March 2020. Meaning that any given correlation does not necessarily exist all the time. It can be stronger, weaker, or completely random and kick back in after a while. There were also periods of time where the two almost move in tandem, like from 2016 to 2018 and prior to that as well. The major gold bull markets had also led to a major bull market in the Aussie dollar back in 2009 to 2012. With a bullish gold price, we also want to be buyers in the Aussie dollar. So we would go to the Aussie dollar chart and look for high quality demand. And this is how correlations then would add context to our higher time frame chart analysis. Here you can see the long-term relationship between the yen and gold. They generally move in the opposite direction, although they do not do this at the exact rate of speed all the time. Now recently, there's also been a shift in yen prices, with the yen just going sideways and being range bound. Therefore, you can see that the correlation has been pretty much random lately. But going back in time, you can see major drops in the value of the yen and major rallies in gold prices during the same time frames. So if you want to set up a correlations workspace on your TradeStation, simply go to data at the top of the window you want to change, then add symbol and type in the symbol you're looking for. Here note that TradeStation cannot compare all symbols. So sometimes for equity indices, we need to use the stock market ETF symbols like SPY for S&P 500 or QQQ for Nasdaq. Sometimes it is also better to use GLD for gold or UUP up for the dollar. So here I will add the dollar to my chart with the symbol $DXY. And as you can see, TradeStation is giving me the error message. You cannot mix symbols with different delays in the same window. So here I would go to data, edit symbols, and customize the dollar symbol and exchange it with UUP. Now I have two charts, but I want to see them with one axis, right? So I simply double click on the lower chart, go to scaling and change the subgraph to 1. And voila, dollar versus gold in one chart with one axis. Now you can change the candlesticks to line charts and change the color of the lines depending on how you just like it. Just once again, double click on the chart you want to change, go to style and change the bar type, color and or weight. And lastly, to add the statistical correlation coefficient, just right click the chart, go to studies and add study and add the correlation indicator. Double click on the indicator chart to change the format under color and style, and here you go. What we can see here is that since March, also the US dollar and gold pretty much go into the opposite direction and are highly negatively correlated, even though they do not move in the same rate of speed. This is also a good correlation to look at during certain times, because as the dollar is being devalued, gold becomes more attractive as gold is also priced in US dollars. Let's look at the MRCI correlation table, which is what I want you to check every month to see if there are any specific correlations we should be looking out for over and beyond what we just covered, and how relevant these are at the moment. Here we can look at different time frames. What you see is a time frame of 180 days, but you could also be looking at a 30-day, 60-day, or 90-day correlation matrix. We talked about crude oil and the Canadian dollar, right? So look at this, 88% positive correlation. Makes sense, right? We also talked about gold and the US dollar, negative 60% correlation. Also makes a lot of sense. Aussie and gold right here, look at that, positive 56% correlation. Here you can also find Forex specific correlations like the euro and the Swiss franc, or the Aussie and the euro, or the Canada dollar and the pound. As you can see, there are a lot of other correlations that may be relevant at the time. And this is how you would check your trade ideas and whether your trade ideas are highly correlated. If they are, great. You can use this as an additional zone qualifier to add additional higher time frame context to your trade setups, but also it means we shouldn't be trading two highly correlated products at the same time, as we would just be multiplying our risk. And the goal is to trade positions that are diversified. So this is the summary. We have to include the MRCI table into our weekly and monthly trading routines. We want to use existing correlations to look at supply and demand zones and map them to the correlated product as a zone qualifier. This is how you can add higher time frame context and additional probability to your setups. Use existing correlations to ensure diversification. Manage your risk at all times and do not trade two products that are highly correlated at the exact same time. Alright everyone, this lesson is very relevant today because cross assets have been moving very much similarly, and there are a lot of relevant correlations across the board, across assets we need to have on the radar when navigating the markets. I will catch you all for the next lesson. Thanks everyone, and until then, happy and safe trading, and ciao.